I'd like to now take a stab at another type of activity that tends to create deferred taxes, and that has to do with revenue recognition. We have a magazine subscription, a company that sells magazine subscriptions, which generated cash revenue in the amounts of 120, 180 over 3 years, and reported those annual amounts to the IRS. But because some customers are prepaying for magazine subscriptions, in accordance with GAAP, the company actually could only recognize $100 every year instead of 120 immediately. So this is more accrual accounting versus cash accounting, or more aggressive revenue recognition, or I should say more conservative revenue recognition versus more aggressive revenue recognition. What is going to be the disconnect between book and tax accounting as a result, and how are deferred taxes going to play a role? This one is a little bit trickier than the prior exercise because there are a couple of other moving pieces. Hit the pause button, try it, and then we'll go through it together as a group. Let's start with book revenues. And here we have book revenues of 100 every year. Now for tax purposes, as the example showed us, we have revenues being recognized a little bit more aggressively. Keep in mind here, it's the same $300 million worth of total revenues. The only difference here is a temporary timing difference of when they're being recognized. And what we're trying to understand is the impact on the financial statements as a result of these timing differences between book and tax accounting rules. And so pre-tax income ends up being 50. Now, the one thing to keep in mind is for tax purposes, this is actually the cash revenue. And while for book purposes, it's accrual-based revenue, right? So the numbers that we're identifying here for pre-tax income is actually what went into my pocket. This is more of an accrual concept. So the taxes here are being driven off of a $50 million pre-tax income every year. So that's pretty straightforward. Whereas for tax purposes, the actual payable is 28, much higher in the first year, the same in the second year, and then a reversal in the last year. Some may be wondering, why go through all this? Why not just identify, for book purposes, the exact amount that you owe to the IRS? And that would certainly make things simpler here. We don't have to sort of create our own hypothetical GAAP-based tax expense. And this is a little awkward, right? This is the actual tax you have to pay for tax purposes, but then we're coming up with this sort of GAAP-based number of what GAAP thinks is the appropriate tax expense. And the only answer I can provide as to why not use the actual tax, the actual current tax liability, is accrual accounting. Accrual accounting dictates that we match not only operating expenses, but all expenses, including tax expenses, with the associated benefits. And that's essentially accrual accounting in action. So this is a consistent accrual-based income statement. I did digress a little bit. Let's get back to the task at hand. We have net income of 30 every period. So this GAAP-based income statement is fairly straightforward. And then this tax income statement that, as a reminder, you don't have access to usually. This is just, if we had access, this is what it would look like using the IRS's tax rules for revenue recognition. And what you see is, very different net incomes every year because of the different revenue. So let's start with the easy stuff. The easy stuff is, just like before, we have debt of 20 across the board. No changes to debt. We have property, plant, equipment. In this case, no changes there. All right, so it's going to be 50. It's going to sit at its carrying value. There's no depreciation being recognized on the income statement or anything like that. Common equity. The last line that's, I would say, obvious is just common equity. Common equity grows by net income every year. There are no dividends. That's the only thing that would make this go up. There's no equity being issued. That would be another thing that would make it go up. There are no share buybacks. So it's simply growing by the net income recognized on a GAAP basis. And that's, I guess, the one key thing to keep in mind, that this is a GAAP-based balance sheet. So equity goes up by GAAP net income. So here we are. We have assets of 50 and we have common equity of 80 in the first year. The next year, there's yet another divergence, 50 in total assets that we've recognized, and then 110. So one final line item before we talk about deferred taxes is cash. So we haven't talked about cash yet. How much cash is actually going into our pockets every year? For that, as we've already talked about in the prior example, we got to look at the actual tax payable as opposed to the tax expense. We have cash going into our pockets on an operating level of 120 minus 50 or 70, and then we're paying 28 in taxes. So this is literally the line. It's all cash here that we bring in. So cash goes up by 42. The next year there's an incremental 30 of cash coming in, so that brings us to 72, the original 42 plus the 30, and then 72 plus 18 is 90. So this is what's happening. We still have this disconnect. Now we have 92 versus 80. Where is this disconnect coming from? There are two things happening. This is what makes it a little trickier than the prior exercise. The two things that are happening is, first, there is some unearned or deferred revenue. In our basic accounting class, we talked about the concept of deferred or unearned revenue. And that is when a company recognizes $100 in revenue from a GAAP perspective, but has actually received $120 million worth of receipts for sales. 20 of those are unearned, and they're recognized as unearned. In other words, they're not recognized on the income statement, but obviously the cash received from them creates a debit to cash. Well, the offsetting entry is the creation of a liability called unearned or deferred revenue of 20, right? The difference between what was recognized, the 100 that was recognized, and the 120 that was received. And it's a liability because it represents an obligation to actually provide goods or services for the revenue that was received in advance. And so the next year, nothing is happening because, or I should say, the balance stays as 20. In other words, there's no change, but this is a balance sheet. So the balance stays at 20. And then the next year, the balance goes down by 20 to get to 0. So we're still not in balance, though. 92 compared to 100. Here we have 112 compared to, where are we at? 130. So 112 compared to 130. So there's still differences. Assets still don't equal liabilities plus equity. What's the plug? Is it deferred tax assets, deferred tax liabilities? Well, here the plug is going to be a deferred tax asset, not a deferred tax liability. This is a trick to sort of distract you. It's not going to be anything here. The reason why there's a deferred tax asset is because we are saying in year one that even though we only recognize a tax expense from an accrual perspective of 20, because we only recognize revenues of 100, for tax purposes, the IRS has recognized a whole boatload more of revenues and therefore are now expecting much more in taxes. Again, this is a temporary timing difference. This will reverse itself come 2017. But for now, we paid less, we paid more rather than we, from an accrual perspective, we owe. And it means that down the road, now that we've paid more, because we've paid more in actual cash than under GAAP believes that is the appropriate tax expense, we recognize the difference, that 8 difference, until the reversal. The next year there's no difference. The next year there's no difference. So we maintain that deferred tax liability of 8, and then in the last year, we recognize much more, 20 in tax expense than we owe. This is that reversal, bringing you down to 0. So if we did this all correctly, we should have total assets equaling 100, which should exactly equal my liabilities plus equity. My liabilities being 40. Let's actually fill in the blanks here. And 20, bringing us to 100 in the first year. So this is a check. Sorry, this is a check. As equity plus liabilities equals 100, which does exactly equal the total assets. And then here we have a check as well. Total assets are 130. And that exactly equals total liabilities plus equity of 130. So our balance check equals 0. There's no problem. Or I should say, let's make this like a checkbox. Yes, it worked. And then lastly, we have 140 and 140 for liabilities plus equity together. So we're in check. So as you see, this is now a situation where deferred tax assets are being created to recognize these temporary timing differences.